Nate, kick us off here. Hey, let's talk firstly about this kind of like failed Russell rotation the last couple days. Is it just the nature of the beast? It's more volatile or what?
You know, it's tough to say. So on the one hand, I think that, part of the psyche within investors' minds is that, look, rates are coming down. Soft landing is looking more likely. The Fed is likely done. If the economy is going to hang in there okay, then don't the underperformers deserve some kind of a catch-up trade because of the valuation difference there? That's provided at least three thrusts that we've seen on the Russell. One was from the non-farm payrolls back in November, then the CPI, and then Friday and Monday, we saw big thrust outperformance, money flow into the Russell, that rotation that you're referring to. Today, we're taking a little bit of a break. The Russell is the worst among the majors that's performing. I'm wondering if it has to do with that note from Katie Huberty from Morgan Stanley, just basically saying that the smartphone demand for the AI edge, that's AI being implemented onto basically smartphones and other kind of devices, that hasn't been priced in. That gave a pop to Apple, and maybe that triggered some of the money flow back to technology. So the question I have here for the month of December, is there more here to the rotation into the underperformers? The other thing that's working against that, at least in this month, is tax loss selling. So we'll have to wait and see.
Yeah, I like that point. Kind of tracking where we are and the potential of that rotation to value or beaten down stuff. As you mentioned, some of the AI news flow. Just a little quickie here. I mean, NVIDIA's below some of these moving averages, Nate. Today, kind of dabbling with that 50-day. What happens if any of these big mega cap leaders fade more?
Well, if they fade more, what you're going to see is at the level of the S&P for those market cap weighted indices like we saw yesterday, is that you're not going to see a lot of performance on the S&P because they have so much, weight within that index. But underneath the covers, you might see some of that rotation that goes on. In regards to NVIDIA, though, Oliver, it's been consolidating between 400 and 500 since late May, basically. And so those moving averages begin to move sideways. So their relevance as a support level is not so much there. So until otherwise proven, NVIDIA's support is basically 400, resistance is basically 500. It's getting a little bit of play today. It looks like it's okay. It's digesting some of the move it had running up into the report. The report looked really good. The AI story is intact. So I think right now investors are just saying, is there going to be incremental alpha if I go for some of the underperformers, or do I stay with basically the safety trade, those that have the more fundamental growth story intact?
Got it. All right, love the stock talk there. Let's get some bonds into the mix. Believe we got Kathy back with us. All right, Kathy, this morning's data for JOLT seemed to really put a jolt back into bond bulls after a brief pause on Monday. How important were that data this morning, both for ISM and particularly what we saw there for JOLTS?
I think the jobs data, probably the more important. ISM services still showing some expansion, just moderate expansion. But I think when you look at the JOLTS numbers, this is just the playbook that the Fed wanted to see for a soft landing, right? A loosening of the labor market, the balance between supply and demand labor kind of coming back to a more pre-pandemic level. It's not there yet, but it's moving in that direction. So this is positive news for the Fed. Reinforces the idea that they don't need to tighten anymore. I think maybe the short end of the market's gotten a little too enthusiastic about the amount of rate cuts we'll see sooner rather than later. But it did seem to confirm the kind of the soft landing, slowdown in the economy scenario that has been playing out.
Does it look like it fits the rate cut timeline, or at least the direction as we push forward the cut expectations? Should we expect data to meaningfully weaken or hasten the pace at which it does weaken?
In a normal, or there's no normal cycle, let's say in past cycles, you would expect the Fed to respond to the softening in the economy, the decline in inflation, especially some of the real weakness we've seen in manufacturing, the softness in the global economy. You would expect the Fed to be forward-looking and cut rates sooner rather than later, and that is what the market's pricing in. I think the difference this time around is that the Fed's reaction function is different, or at least that's what they're telling us.